Do you worry about President Trump showing up at NATO, going after Germany because of the surplus, so linking trade, of course, with defense spending? And where does that leave German car makers?
Well, I do think that it would be a concern if kind of trade barged back onto the headlines. I think markets have in some ways had a bit of a relief that there was an enormous amount of focus on trade up until kind of last week. That has died down a little bit. It's gone to a quiet period, even as those tariffs have gone into effect. But certainly, I think kind of headlines that's been a major point of contention would refocus the markets on something that is going to be a big deal for the second half. That trade, we do think, is a risk to growth. It's one of the reasons why our U.S. GDP numbers are somewhat lower than consensus. And I do think that's a challenge that markets are going to still have to face in the second half. It hasn't by any means gone away.
But Andrew, overall, does it mean that you're actually short European equities? Have we seen the best of it in Europe?
So I'm actually optimistic the European equities over the near term can actually have a pretty good earnings season, right? If we think about what happened in the second quarter, the euro was quite a bit weaker. Commodities were quite a bit stronger. Global GDP growth was pretty good. And those three things, if you wanted a combination of three factors to help European earnings, I think it would be those three factors. But then there is a risk that's as good as it will be, or that's the point where you're supposed to take some chips off the table. And my colleague Graham Secker, our European equity strategist, has lowered his 12-month target for European equities. He's taken down his estimate for what the multiple should be kind of over the next 12 months. And so I think it is one where I think earnings season could be good, but we have to be aware of those risks to trade that Europe is quite exposed to.